Picture this: you just had a fantastic week. You were disciplined, you stuck to your plan, and your account was looking great. Then, in one or two trades, it all came crashing down. You didn't just give back your profits, you gave back more. If you feel trapped in this vicious cycle of amazing wins followed by catastrophic losses, I need you to hear this. It's not bad luck, and it's probably not your strategy. It's a predictable, six-stage blowing up cycle that can turn even the most disciplined trader into an emotional wreck. This pattern is so common that some estimates suggest over 90% of traders face huge, account-threatening losses at some point. In this video, we're going to drag all 6 of these deadly sins into the light, and more importantly, I'll show you exactly how to break free from each one. Because traders don't fail because their system is wrong, they fail because they haven't learned to manage themselves. The first deadly sin is revenge trading. Let me ask you something. You've just taken a loss that stings. It was bigger than you planned for, and it just erased the wins from your last 3 trades. What's your immediate impulse? Do you shut the laptop and walk away, or do you feel this intense, burning urge to jump right back into the market and win it all back right now? If you picked option 2, you've just met the first and most destructive sin, revenge trading. Revenge trading is nothing but an emotional, impulsive tantrum after a loss. It's a psychological trap where you throw your strategy out the window, fueled by anger and frustration, in a desperate attempt to erase the pain of losing. Your brain isn't calculating probabilities anymore. It's in fight or flight mode, and it sees that loss as a personal attack. The signs are classic. After a loss, you suddenly double or even triple your position size. You jump into a garbage setup you'd normally ignore. You start chasing price, convinced you can bully the market into giving you your money back. At that point, you're not trading, you're just gambling out of spite, and the consequences are brutal. This is exactly how a single, manageable loss snowballs into a catastrophic one. It's the first push that sends the dominoes falling. So how do you stop it? This isn't about willpower, it's about having a system. First, create a non-negotiable rule. After a big loss, you walk away. Don't just minimize the charts. Stand up, leave the room, and do something completely unrelated for at least 30 minutes. This physical break creates a mental one, letting the adrenaline fade. Second, your trading plan needs a hard daily loss limit. This isn't a suggestion, it's your kill switch. If your account drops by a preset amount, say 2%, you are done for the day. No questions, no exceptions. This rule is there to protect you from your worst enemy, your emotional self. Finally, use a trading journal to log not just your trades, but how you felt. Write it down. Recognizing the emotional trigger is the first step to disarming it. The second deadly sin, removing stop losses. All right, your trade is moving against you. It's crawling toward your stop loss. The exact point you decided was your absolute maximum risk. As it gets closer, a little voice in your head starts whispering, "It's just a liquidity grab. It's gonna turn around any second. Just give it a little more breathing room." Do you let the stop get hit, or do you grab it and drag it further down, praying for a miracle? This is the second deadly sin, moving your stop loss. This sin is fueled by 2 things, the fear of being wrong and an ego that desperately needs to be right. Taking a loss feels like admitting you failed. So instead of taking that small, planned loss, you decide to gamble. You move your stop from 50 pips to 100, then to 150, basically tearing up your own risk plan in real time. You just turned a disciplined trade into a wishful bet. The result of this one sin is probably the biggest reason for catastrophic account blowouts. That small, paper-cut loss now has the potential to become a fatal wound to your account because you've removed your only safety net. Instead of letting your strategy tell you when you're wrong, you've decided to let your entire account balance make that decision for you. This is how traders end up holding on to losers for days, even weeks, watching a small drawdown eat their entire capital. The fix is to treat your stop loss as sacred. Once you set it, it's written in stone. You do not touch it, ever, unless it's to move it in your favor to lock in profit. The best way to enforce this is to develop 100% compliance. You have to train yourself to follow this rule like your career depends on it, because it does. Some pros can do this with pure mental fortitude, but for the rest of us, the answer is automation. Set your stop loss order the second you enter a trade, and never, ever override it to increase your risk. Start seeing your stop loss not as a failure, but as a mark of professionalism. It's the cost of doing business in a game of probabilities. The best traders aren't afraid of being wrong. They're obsessed with being wrong quickly and cheaply. The third deadly sin. Over-leveraging to recover. You're down 20% on the account after a rough week. You can feel the pressure mounting to make it all back and fast. The thought of grinding it out with your usual 1% risk per trade feels agonizingly slow. Then, a dangerous idea pops into your head. What if I just crank up the leverage on the next trade? If I nail it, I can make it all back in one shot. Welcome to the third deadly sin, over-leveraging to chase your losses. This mistake is born from a nasty cocktail of desperation, impatience, and misplaced confidence. After a few losses, your judgment gets cloudy. You start to feel like a big win is due, a classic gambler's mistake. So you crank the leverage way up, or you jack up your lot size from a 0.1 to a full 1. You're no longer managing risk, you're pulling the handle of a slot machine and hoping for a jackpot. The brutal reality is that high leverage magnifies everything, especially your mistakes. A tiny price move against you, which would have been a minor blip with proper sizing, now triggers a margin call and vaporizes your account. It's like pouring gasoline on a fire to try and put it out. This is a huge reason why so many retail traders fail. They treat leverage like a get-rich-quick button instead of a professional tool that demands respect. The solution requires a deep mindset shift. You have to separate your desire for profit from your risk process. Your number one job as a trader is not to make money, it's to protect the money you already have. The unbreakable rule is to cap your risk at 1 to 2% of your account on any single trade. This isn't just a friendly tip, it's the mathematical bedrock of a long-term trading career. It guarantees that even a nasty string of losses won't take you out of the game. Before you even think about hitting buy or sell, use a position size calculator to figure out the exact lot size for your 1% risk. This isn't optional, it's procedure. When you focus on a perfect risk process instead of the dollar amount, you kill that emotional need to make it back and let your trading edge actually work. The fourth deadly sin. Trading high-impact news without a plan. The non-farm payroll report is about to drop. The market is dead quiet, coiled like a snake. You don't have a specific strategy for this, no backtested plan, but the fear of missing out FOMO is killing you. You think, this is going to be a monster move, I just have to be in on it. As the numbers flash, the chart explodes. Do you slam buy or sell, based on nothing but a gut feeling? This is the fourth deadly sin, trading high-impact news without a plan. This sin is pure FOMO mixed with a gambler's impulse. Big events like central bank meetings or economic reports flood the market with insane volatility. Price action becomes chaotic and unpredictable, and it often couldn't care less about your technical levels. Jumping into that environment without a pre-planned, tested strategy is like trying to cross a 6-lane highway with a blindfold on. You're just reacting to the noise. The consequences are fast and painful. You get caught in vicious whipsaws where the price screams up, stops you out, then immediately reverses and screams down. Panic kicks in. You either freeze up or, even worse, you make things worse by jumping into another unplanned trade. This chaotic environment is a breeding ground for all the other sins we've talked about. The solution isn't to hide from the news, but to approach it like a professional. You have two choices. The first and safest for most traders is to simply be flat. That's it. Put no trade windows in your calendar around major news events. If you don't have a proven edge for trading news, the best move you can make is no move at all. Protect your capital and wait for the chaos to settle. The second option is for more advanced traders. You must have a dedicated news trading strategy that you have backtested, and that clearly defines your entry, exit, and risk before the news hits. For instance, a plan might be, wait for the first 5-minute candle to close after the release, then trade a breakout of that candle's high or low with a set stop. Whatever the plan is, it has to be made when you're calm and objective, not invented in the heat of battle. The fifth deadly sin, lack of a defined edge. You're staring at the charts. You see a pattern that looks sort of like something you saw in a YouTube video last week. You take the trade, it's a loser. The next day, you're on a forum and read about a new indicator, so you slap that on your charts and give it a try. Another loser. You feel scattered and anxious because, let's be honest, you're guessing. You don't have a system you truly trust. You're committing the fifth deadly sin, trading without a defined and proven edge. An edge is just your specific, repeatable method that gives you a slight advantage over time. Without one, you're not trading, you're gambling. This sin comes from a lack of discipline and the desire for a shortcut. The main symptom is system hopping, ditching your strategy the second you hit a few losses. Because you don't have a deep, statistical trust in your method, you have no reason to stick with it through a normal losing streak. This leaves you in a constant state of doubt and anxiety. The consequence is a guaranteed trip to zero. If you don't know what your edge is, you can't know if you're even executing it right. You can't tell the difference between a good trade that just happened to lose and a genuinely bad trade. You have no way to improve, no foundation for confidence, and no defense against your own emotions. You will always be a victim of your feelings because you have no logic to fall back on. The solution is to do the hard, boring work that most traders want to skip. You must define, backtest, and forward test your strategy until you have unshakable confidence in it. A real edge has a few key parts. What exactly is your setup? What is your precise entry trigger? Where does your stop loss go? And what are your rules for managing and exiting the trade? Write it all down in a formal trading plan. Then, go back through historical charts and find at least 100 examples of your setup. Collect the data. This is what proves to you that your system actually works over time. This process isn't sexy, but it's the only way to build the deep belief you need to follow your plan, especially when you're stressed out during a drawdown. The sixth deadly sin. Emotional exhaustion and the redeposit cycle. You did it. You blew up your third account this year. As you stare at the zero balance, you feel this crushing wave of despair, shame, and failure. You close your trading platform and swear you're done for good, telling yourself you're just not cut out for this, but then a week goes by. The pain starts to fade, and a little flicker of hope comes back. You think this time will be different. You deposit more money you probably shouldn't be risking, and the whole nightmare starts over. This is the sixth and final deadly sin. Giving in to emotional exhaustion and repeating the cycle. This sin is the final link in the chain, the one that guarantees the cycle of destruction continues. It's driven by a toxic mix of despair and false hope. The repeated trauma of blowing up accounts reinforces a negative identity. You start to believe that you are a losing trader. This pushes you into a gambling mindset, where every new deposit isn't about professional risk-taking. It's a desperate lottery ticket to finally hit the jackpot and prove you're not a failure. The result is permanent burnout. Your decision-making is always tainted by past trauma. You get scared of taking good setups because they remind you of past losses, but you'll jump into impulsive trades hoping to short-circuit the pain. Financially and emotionally, you are trapped on a hamster wheel, running faster and faster but going nowhere. Doomed to repeat the same mistakes until you either run out of money or have a complete breakdown. Breaking this final, most vicious cycle requires a total change in your approach. First, you have to accept that recovering from a blowout is a process, not a feeling. Step 1, take a long break from live trading. Get back on a demo account, not as a punishment, but as a professional rebuilding confidence in a safe space. The goal isn't to make fake money, it's to execute your plan with 100% discipline for 50 or 100 trades in a row. Prove to yourself that you can actually follow your own rules. Second, you have to work on your mental recovery. Things like meditation, mindfulness, or even just journaling about your goals can help disconnect your self-worth from your P&L. You are not your last trade, you are a professional in training. By focusing on process, discipline, and mental health, you stop being a gambler chasing a win and become a business owner managing risk. So there you have it, the 6 deadly sins that create the blowing up cycle. Revenge trading, moving your stop loss, over-leveraging, gambling on news. Having no edge in the burnout cycle of redepositing. Do you notice the pattern? None of these are about the market being against you. They're not about your indicators or strategy being wrong. They are all about you. Every blown account is the result of a series of undisciplined choices made under the influence of fear, anger, greed, and desperation. But here's the empowering truth. Because they are choices, you can choose differently. You can choose to walk away after a loss. You can choose to honor your stop. You can choose to risk 1% and protect your capital. You can choose to have a plan. You can choose to do the hard work, and you can choose to treat this like a profession, not a casino. The cycle only breaks when you decide to stop being an emotional participant and start being a disciplined professional. The market will always be here. Your job is to make sure you are, too. What's the one sin you struggle with the most? Let me know in the comments below. Sometimes just admitting it is the first step to beating it. And if this video helped you see your own trading in a new light, make sure to subscribe for more content on mastering the psychology of the markets. Trade with discipline, and I'll see you in the next one.